In 2008, while the world economy collapsed and the S&P 500 lost 38%, a hedge fund on Long Island made 82%. In 2020, during a global pandemic that destroyed millions of jobs, that same fund returned 76%. For 31 consecutive years, from 1988 to 2018, this fund never had a single losing year. Not one. If you had invested $100 in 1988, by 2018, you would have $398 million. But here's the thing, you couldn't invest, because in 1993, the fund closed to outside investors. And in 2005, they bought out the last remaining outsider. Since then, only employees and their families can invest. This is the Medallion Fund, the most successful investment vehicle in human history, and the ultimate paradox. They discovered a money printing machine. Then they kept it for themselves. Let's start with a simple question. How good is the Medallion Fund? From 1988 to 2018, the fund averaged 66% returns per year before fees. 66%. Every single year. For 30 years. After their eye-watering fees of 5% management and 44% performance, investors still netted 39% annually. To put this in perspective, Warren Buffett averaged about 20% over his career. George Soros averaged around 30%. The Medallion Fund doubled them. The fund has generated over $100 billion in trading profits, despite the average fund size being just $10 billion. That means they've made 10 times their assets. It's not just good. It's statistically impossible, and yet it happened. The story begins in 1978. Jim Simons was a 40-year-old mathematician who had just left his tenured position at Stony Brook University. He wasn't a finance guy. He had a PhD from Berkeley. He had taught at MIT and Harvard. He had worked as a code breaker for the National Security Agency during the Cold War. He had won the Veblen Prize, one of the highest honors in mathematics. And he was bored. Academia wasn't enough. So he decided to apply his pattern recognition skills to financial markets. He founded a firm called Monometrics, which later became Renaissance Technologies, and started trading currencies and commodities. It was modest at first. Some good years, some bad years. Nothing revolutionary. But Jim had a vision. He believed that markets weren't random. They had patterns. Hidden correlations that could be discovered with enough data and sophisticated mathematics. The problem was he needed better people. In 1988, Jim assembled a team that would change everything. He recruited Leonard Baum, a famous mathematician who had worked on speech recognition, James Axe, an algebraist, Elwyn Berlekamp from Berkeley. These weren't Wall Street guys. They were scientists, academics, people who thought in algorithms and probabilities, not in gut feelings and market sentiment. Together, they built something unprecedented. A fully automated trading system that used mathematical models to find inefficiencies in markets. They called the fund Medallion, named after the math awards that Simons and Axe had won. And in 1990, after a rough start, the system started working. Really working. Here's what made Medallion different. Every other hedge fund tried to predict whether markets would go up or down. Medallion didn't care. They weren't making directional bets. They were making thousands of tiny trades, exploiting microscopic price differences that existed for seconds or minutes. Statistical arbitrage, high-frequency trading, pattern recognition at scale. They were right just 50.75% of the time. Barely better than a coin flip. But when you make 150,000 trades per day and you're right 50.75% of the time, that tiny edge compounds into massive profits. It's not magic. It's mathematics. But the real genius was understanding risk. Most hedge funds blow up because they make one big wrong bet. Medallions spread their bets across thousands of positions, simultaneously. Stocks, bonds, commodities, currencies, futures, options, everything. If they were trading 10,000 different assets at once, the risk from any single position was negligible. Diversification at an inhuman scale. And because their holding periods were so short, often just hours or days, they were never exposed to major market moves. They could be in and out before crashes happened. This is why Medallion could have negative market beta. When the market went up, Medallion made money. When the market crashed, Medallion made even more money. It was uncorrelated to everything. By the mid-1990s, the performance was so extraordinary that Jim Simons made a decision that shocked Wall Street. In 1993, he closed Medallion to new outside investors. Then in 2005, he bought out the last remaining external investor. From that point forward, Medallion became an insider-only fund. Only Renaissance employees and their families could invest. The official reason? Capacity constraints. The strategies only worked at a certain scale. If the fund got too big, the inefficiencies they exploited would disappear. Their edge would vanish. So they capped assets at around $10 billion and kept it exclusive. But there's another reason nobody talks about. Greed. Pure, rational greed. Why share the money printing machine with outsiders when you can keep it all for yourself? And this is where the story gets interesting. Because Renaissance does run other funds for outside investors. The Renaissance Institutional Equities Fund. The Renaissance Institutional Diversified Alpha Fund. These funds manage about $55 billion for external investors. Pension funds, endowments, wealthy individuals. People desperate to access Renaissance's legendary performance. But here's the brutal truth. Those funds don't use the same strategies as Medallion. They can't. The strategies don't scale. So what do outside investors get? Mediocrity. In 2008, while Medallion gained 82%, the Institutional Equities Fund lost 16%. In 2009, while Medallion made money, the Equities Fund lost another 6%. In 2020, while Medallion surged 76%, the Equities Fund lost 22%. 22%. Renaissance literally has two classes of investors. Insiders who get 76% returns, and outsiders who lose money. Think about the audacity of this. Renaissance is telling the world, we have the greatest investment system ever created, but you can't use it. Only we can. You can give us your money for our other funds, which don't work nearly as well. And we'll charge you fees while underperforming the S&P 500. It's like discovering the cure for cancer and keeping it for your family while selling everyone else a placebo. It's legal, it's rational, but is it moral? During a 2009 conference call, outside investors asked Renaissance managers a direct question. Why did the equities fund lose 17% between January and April, while Medallion, the internal fund for billionaire Jim Simons and other managers, returned 12%? The managers gave technical answers about different strategies and holding periods. But the real answer is simpler. The good stuff is for us. The mediocre stuff is for you. Let's talk numbers. From 1988 to 2018, Medallion turned $100 into $398.7 million. That's not a typo. 398 million. With an M, during the same period, the S&P 500 would have turned that $100 into maybe $2,000. Even if an investor had perfect foresight and moved all their money to treasury bonds before every crash and back to stocks before every rally, they would only have turned $100 into $331,000. Still nowhere close to Medallion. The fund didn't just beat the market. It operated in a different universe. And the people with access to this performance became unimaginably wealthy while everyone else got the leftovers. Jim Simons himself became worth over $30 billion by the time of his death in 2024. Other Renaissance executives, like Robert Mercer and Peter Brown, became multi-billionaires. But it's not just the founders. Even mid-level employees at Renaissance have become extraordinarily wealthy, because about 100 of Renaissance's 275 employees are qualified purchasers, meaning they have at least $5 million to invest in Medallion. The remaining are accredited investors worth at least $1 million. Working at Renaissance and having access to Medallion is like being given a license to print money. Stay for 10 years and you retire rich. Stay for 20 and you retire with generational wealth. It's not a job. It's a wealth extraction machine. But here's where it gets uncomfortable. What is Renaissance actually contributing to society? They're not building products. They're not creating jobs. They're not curing diseases or solving climate change. They're extracting money from financial markets. $100 billion in profits over 30 years. Where does that money come from? It comes from other traders, from pension funds, from mutual funds, from individual investors. Medallion is essentially a tax on everyone else in the market, an efficiency that they capture and convert into personal wealth. And they do it so fast and so quietly that most people don't even know it is happening. This raises philosophical questions. Is it ethical to discover a systematic advantage and keep it exclusively for yourself and your colleagues? Renaissance argues yes. They took the risk. They built the system. They deserve the profits. But others argue that the financial system is supposed to allocate capital efficiently. It's supposed to serve the real economy. It's not supposed to be a game where a few hundred mathematicians extract billions from everyone else. Medallion doesn't help companies grow. It doesn't fund innovation. It just moves money from one pocket to another, specifically into Renaissance's pocket. It's profit without purpose, wealth without creation. The ultimate example of financialization run amok. And the worst part, nobody can replicate it. After Medallion's performance became public, every hedge fund on the planet tried to copy them. Citadel hired mathematicians. Bridgewater brought in data scientists. 2 Sigma built sophisticated machine learning systems. Everyone tried to become the next Renaissance. And they all failed. Some funds did okay, 15% annual returns, 20% if they were lucky, but nothing close to 66%. The technology isn't the secret. Anyone can buy powerful computers and hire smart people. The secret is something else. Culture, integration, long-term thinking. At Citadel, different teams compete for capital. At Renaissance, everyone collaborates on one unified model. At 2 Sigma, successful strategies get spun into separate funds. At Renaissance, everything stays integrated. It's not just what they do, it's how they're structured. But even Renaissance might be reaching limits. In 2022, Medallion returned only 33%. Only. Still spectacular, but half their historical average. Some analysts believe the fund is hitting capacity constraints, even at $10 billion. The inefficiencies in markets are being arbitraged away by better technology and more competitors. The edge is shrinking. And as artificial intelligence becomes commoditized, with anyone able to rent equivalent computing power from Amazon for a few $1 million, the infrastructure moat is evaporating. Renaissance's advantage came from having computers 100 times more powerful than competitors in 1990. Today, that advantage no longer exists. The question isn't whether Medallion will continue making money. It's whether they can maintain their otherworldly returns as the rest of the world catches up. Let's return to the central paradox. Medallion's proven that markets are not efficient, that systematic edges exist and can be exploited for decades. This should be impossible according to financial theory. Yet it happened, and continues to happen. But that proof is locked away, hidden behind non-disclosure agreements and insider-only access. The greatest financial discovery of the modern era benefits a few hundred people, while the rest of the world is told markets are random and you should just index. It's the ultimate irony. The evidence that active management works is only available to people who already have access to the best active management. What's the lesson here? If you're smart enough and have access to the right resources, you can beat the market systematically for decades. But if you're not part of that exclusive club, you're better off indexing, because everyone else trying to beat the market will likely fail and charge you fees in the process. The game is rigged. Not in the illegal sense, but in the structural sense. The best opportunities are reserved for insiders. The rest of us get the scraps. Medallion is the proof. The fund that shows how unfair the system really is. Because when you discover a money printing machine, you don't share it with the world. You keep it for yourself. Jim Simons passed away in May 2024. His legacy in mathematics and philanthropy is secure. He donated billions to scientific research and education. But his legacy in finance is more complicated. He proved that markets can be beaten, but he kept the blueprint secret. He built the most successful fund in history, but made it available only to the wealthy insiders who already had millions. He extracted $100 billion from markets, but contributed nothing to the real economy. Medallion is a monument to human ingenuity, and also to human selfishness. The machine that prints money, that only the chosen few can use. If this story made you question the fairness of financial markets, you should, because Medallion proves that the game is rigged. Not by illegal manipulation, but by information asymmetry and exclusive access. The people who know how to win won't teach you. They'll just keep winning, while you're told to buy index funds and accept average returns. That's the real lesson of the Medallion Fund, the ultimate financial paradox. Proof that beating the market is possible for everyone except you.